Welcome to Taking Stock. I'm Amanda Lang. Coming up on the show, as Canadian cities grapple with aging infrastructure, how will they pay to fix it? And the gap for Canadian startups is large and costly. Plus, Canada's Minister of the Environment and Climate Change on the new age of pragmatism. That's all ahead. First, for the week that was in business, it's time for the briefs. U.S. President Trump imposed new global tariffs of 10% this week after the Supreme Court there blocked his previous import duties. The ruling had little impact on Canada, and tariffs remain in place on key sectors, including steel and aluminum. The move increases the level of uncertainty for business, some of whom moved quickly to try to recover tariffs they've already paid. Prime Minister Mark Carney began a three-country trade mission that will take him to India, Australia, and Japan. The visits are intended to spur exports and to invite investment in Canada. Discussions are expected on everything from critical minerals to food security. Loblaw says it will invest $2.4 billion over the next year to build 70 new stores. About half of those will be Shoppers Drug Mart or Pharmaprix stores. 31 will be discount no-frill locations. Loblaw says the expansion will create more than 90,000 jobs. Loblaw reported lighter than expected food sales in its recent quarter, although overall sales rose 9.6%. Canadian banks weathered the softer economy just fine, with strength in their capital markets facing businesses, offsetting weaker outlook for consumers and domestic business. While tariff uncertainty slowed growth, volatile stock markets proved lucrative. Money set aside for potential loan losses did increase slightly, but are down from recent higher levels. There are some grim statistics for real estate in Canada's largest city. Just 269 newly built homes sold in January in Toronto. That's the lowest number since 1981, according to the Building Industry and Land Development Association. That's 36% below last January and 80% below the 10-year average. Canadian generic drug firm Apotex is considering a public listing in the first half of this year that could raise up to $1 billion, according to reports. An IPO of that size would be the largest since 2021. And those are your business briefs. Well, the cost of aging infrastructure rises. The ability of cities to pay for it hasn't changed much. It's a gap that creates a big problem. Rebecca Bly is president of the Federation of Canadian Municipalities. Thanks for being with us.
Happy to be here. Thank you.
So that funding gap is one that is of great urgency for a lot of cities, especially when we think about the huge task ahead of rebuilding infrastructure that we don't even see. What's on the table to try to solve that problem?
So the Federation of Canadian Municipalities works very hard and tirelessly on behalf of our members, advocating the federal government for stable and predictable infrastructure funding. We have a number of sort of ways to get that funding directly into municipalities, but what we know is the urgency is there, and that the dollars need to move quickly into municipalities in order to not only ensure that there's an ability for municipalities to renew aging infrastructure, but also build the infrastructure we need to build our country.
And of course, part of that is with the housing that we need. One place that we're seeing a lot of attention is reducing development fees, because that's seen as a roadblock to building more housing supply. That, of course, comes right out of budgets. So is there a bit of a problem here that we're trying to solve one thing, but we're going to cause an even bigger problem for cities?
Absolutely. Municipalities, people are quite surprised, actually. Municipalities manage and own over 60% of the country's infrastructure, and yet only collect 8 to 10 cents on every tax dollar. Municipal budgets are funded primarily through property tax revenue. And yet municipalities are faced with dealing with modern day challenges that didn't exist when the fiscal tools of municipal budgets were put in place in the late 1800s. So it's time to modernize the fiscal tools that municipalities have before them in order to meet this moment. And so you mentioned development cost charges. This has been something that has been put in place by municipalities as a sort of philosophical growth pace for growth. And we know that the federal government is certainly back in the housing game, and we support their ambitious goal of building 500,000 units of housing across the country. But we can only do that if our toilets can flush and there's roads to drive on. So we need to make sure that municipalities that cannot carry any deficit are able to be kept whole. And so part of delivering housing, part of delivering, a strong Canadian economy, nation building projects is also the fourth leg in that stool, if you will, is making sure that municipal infrastructure is planned for and funded.
So good to have you, Rebecca. Appreciate your time.
Thanks so much for your interest. Thanks. Bye-bye.
Rebecca Bly is president of the Federation of Canadian Municipalities. Coming up, early stage funding gaps in Canada turn into lost opportunity down the line. Stay with us. Canada's startup community is leaving money on the table. Here's a look by the numbers. Canadian startup communities, including Toronto, Waterloo, Vancouver, and Montreal, missed out on $66 billion between 2019 and 2024. Data from a new report by the National Angel Capital Organization and Startup Genome estimate that the lost value is equal to 133,000 fewer jobs and $77 billion US in lower public market value. The study compared growth in Canada's startup regions with others around the globe and found ours grew 2.2% a year in the 5-year period. That compares with growth in the international peers of between 9 and 17%. Part of the problem is that early stage funding is smaller in Canada. So-called seed rounds are 40% smaller than in the US. And Canadian startups take 15 to 40% longer to start raising capital than their American counterparts. The biggest gap was in life sciences. Startups in the sector raised as much as 85% less than similar US companies. AI was also a standout. Canadian AI firms saw 66% lower early funding. The biggest problem with those gaps is they become a vicious circle, with lower returns for early stage investors turning into weaker investments down the road. JF Gauthier is founder and CEO of Startup Genome. Thanks for being with us.
Thank you.
So
Thank you for inviting me.
There's been a sense that Canada lags in the access to capital at early stages, but even those who knew it, JF, I think would be shocked by the data. What do you make of the gap that you see?
Well, it's a very important gap, and that's become structural over the years from 2017, because we've turned our support to Series A and institutional investors, while the angel networks is really the core part of the infrastructure of the entire innovation economy.
And we need, obviously, angel investors to invest and make money in order to keep them doing it. Does it matter that Canada probably has a smaller pool of potential investors? Or when you looked at peer communities, were they accessing investments from all over the world?
Yeah, so all over the world, it's a problem at the angel level, except in the US, where the private investors have made a lot of money in the last 10 and 20 years, and they're reinvesting their profits. All over the world, the governments need to continue to support the angels, leverage the public money into private money, or vice versa, right? Leverage and de-risk the private capital at seed and pre-seed. Otherwise, they can't alone support the innovation ecosystem. And this is the entry of the funnel. This is where you start creating fast growth towards a big Series A, Series B, and an exit that creates economic impact. So if you have a big gap, then growth slows. Fewer make it to Series A, to Series B, you have less exits, and that's where you would get this huge gap in growth that we've seen in Canada compared to the peers.
How much does it matter where the money comes from, JF? How much does it matter if we want Canadian champions and large Canadian businesses and a healthy ecosystem, that early stage funding is also Canadian?
Well, it's very important, but it's always hyper-local pre-seed and seed all over the world, right? Seed investors in Silicon Valley don't invest, except if they're institutional investors. The angels don't invest in another country, in another city. It's very local. So therefore, it will come from local investors, and therefore they need to be supported, because if they're not able to play their important role right now, we need to support them. And that's what the government needs to do. And if we want to take those jobs, right, and we're talking about 133,000 jobs that we could have had if we had continued to grow at the normal pace, we can create those jobs by investing in the infrastructure in the right way and unlock the $66 billion. That's really ours. We can have this market share. We have the innovation power, we have the entrepreneurial power, and now we need the support from the top of the funding funnel.
Is there something simple the government can do? Is it as simple as restoring previous tax credits, or other things that you're suggesting would make it offset some of that risk that we're talking about for seed investors?
Yeah, this is an important angle. So what we see is, of course, the money that went into the fund of funds flow with the private capital to instruments that have higher return, which is Series A, Series B plus rounds, and they underinvest in seed, right? Because the return is low. That means those private angel investors are getting low returns. And in order for them to invest more, it would be good for the government to de-risk their investments, right? Potentially look at investor tax credits, but not at the individual angel level. What you want is facilitate grouping. That's where you build capacity, expertise. You have a lot of deal flow. You write bigger checks faster, which is what we need. And therefore, doing an investor tax credit through the angel sidecar fund would be a good way to go. And that's where the money should go through. It builds up groups. And this is part of the core infrastructure of well-functioning and fast-growing startup ecosystem that produce fast-growing startups.
All right, we'll leave it there. Jeff, so good to have you with us. Appreciate your time.
Thank you.
Jeff Gauthier is founder and CEO of Startup Genome. As uncertainty hangs over Canadian business, will 2026 be the year they invest in themselves? Andrew DeCapua is principal economist at the Canadian Chamber of Commerce with 6 predictions for the year ahead. And the one I'm going to start with, Andrew, is the one that's not great news, which is non-defense business investment remains muted. What's your take on what happens this year?
Yeah, well, one of the things that came out of last year was, of course, high hopes for the business community, right? Big expectations that the federal budget, this momentum, this lowering trade barriers, et cetera, was going to unlock business investment. Now, we haven't really seen that sustained yet. So what we're going to be looking for in the numbers that will be coming out this Friday in terms of GDP numbers is a rebound in final domestic demand. So we're going to want to see the consumer and the business community come back. We don't think that that's going to be coming back strong this year, just because, of course, the uncertainty around trade negotiations, and we just really have the tectonic plates that are shifting beneath us, where businesses don't really feel confident yet to make those big decisions.
Yeah, maybe not until we get a renewed trade deal. You mentioned the other lever, of course, of the economy, and that's the consumer. One of your other predictions is that the consumer pulls back a little bit because of indebtedness. What are we looking for this year?
Well, one of the interesting things coming out of the Bank of Canada's survey on consumer expectations was that the youngest cohort, 18 to 24, may not represent a large part of spending in the economy, but they have the median probability of default for that age category of missing a payment at 50%. And that's concerning. That's been steadily rising, and actually all categories are rising. So with mortgages up for renewals, maybe the younger cohort getting into the mortgage market, going to be renewing at higher rates. We're going to see some pressure there. And as you know, the Prime Minister putting out policy on the GST, GST rebates. There are affordability concerns that are going to put downward pressure on consumption. And of course, population growth slowing. That's going to have a little bit of an impact, actually a major impact rather, on consumption.
And of course, as you also note in your prediction, GDP not do so well, but GDP per capita will because of that change in population. That's just sort of an accounting thing. Just really quickly here, Andrew, when we say that the younger cohort is kind of suffering disproportionately, is that a permanent setback? Is that something that will affect them kind of for the rest of, I don't want to say the rest of their lives, but is it a slightly more permanent setback in economic terms?
Well, we're in an interesting time right now, right? We have AI affecting the younger, like the entry job market, right? Yep. We've seen a lot of jobs removed from that. The unemployment rate was, is double digits for the younger cohort. So we're in this recalibration in the economy where we're seeing movements on trade, we're seeing movements in population, we have interest rates on hold, and we've got this, we're still waiting for a budget, right? So we've got a lot of stuff going on, and hopefully this isn't permanent, but we're in a shift. And so how we adapt to that is going to matter a lot.
Andrew, so good to have you. Appreciate your time today.
Thanks so much, Amanda.
Andrew DeCapua is principal economist at the Canadian Chamber of Commerce. Coming up, Canada's Minister of the Environment and Climate Change on a new deal with energy. That's still ahead. But first, a partial shutdown of the U.S. government is hurting some Canadian travelers. The Department of Homeland Security said it would suspend the Global Entry program after Democrats in Congress blocked funding in a rebuke over ICE detentions. At first, DHS threatened to end all TSA PreCheck, which would have affected American travelers, but stopped short of that for now. It does mean Canadian Nexus card holders traveling to America will lose that express line in case they needed another reason to avoid the country altogether. We're back after this. This week on the Wonk podcast, I spoke to Julie DeBrusen, Minister of the Environment and Climate Change. I started by asking about the change in tone from the federal government when it comes to climate change to a more pragmatic view.
Yeah, I mean, I would say pragmatic, but I would also say collaborative, right? Like, if we are going to continue to work to protect our environment, to reduce emissions, and to build a strong country, strong economically, but also in this moment when we're talking about everything we're facing from the United States, a strong, united country, then we're going to need to work together. And I think that that's the most important thing that I take out of the agreement that we have with Alberta is it's an agreement on how are we going to work on industrial carbon pricing? How are we going to work on interties? People don't talk about that part of the agreement as much, but building interties to neighboring provinces so that we have a strong electrical grid going east-west. The fact that we're at the table and working together is an important space for us to be in right now as a country. And so pragmatic, yes, but I would also say my highline word, if I was going to use one, is more collaborative and cooperative as well.
I asked the minister if this approach will get Canada to its climate goal targets.
What it does is it absolutely gets us towards climate goals, because when I'm looking at what our climate goals are, if we have an agreement, as we do, to work towards stronger methane targets. And in fact, in December, we actually put in place our enhanced finalized methane regulations that will dramatically reduce methane regulations. It's one of the most harmful gases when we're talking about greenhouse gas emissions. It'll bring down, because we put in place stronger ones for oil and gas, but we also put in finalized methane regulations for landfills. That's about 400 megatons of reductions right there with these regulations. And any MOU is part of the agreement about how do we work to continue on reducing methane emissions, which is something that we've actually had a really strong collaborative relationship with Alberta throughout the years on doing. So, are all these pieces, if we're sitting down, one of the main pieces of our climate competitiveness strategy is making sure we have a strong industrial carbon pricing system right across the country. Having an agreement that we're working with Alberta, working with all provinces, frankly, on how do we make the industrial carbon pricing system work and how do we strengthen it, that helps us. That's a major mover in reducing our emissions. And when we have pieces about how do we build out stronger interties between our provinces, we know that we're going to need to build up our electrical grid for that electric future of our country. We can't do it if the provinces aren't better interconnected. So it's a really durable way of going ahead and making sure that we are reducing emissions and that we're doing it in a way that's bringing the provinces together to do it.
I also asked Minister DeBrusen if rolling back the consumer carbon price was a disappointment.
Look, I think that making sure that we have a policy that works in our country in this moment and that Canadians can look at and be proud of and say, I see myself in that, I think that that is the way for the future and the way that we're working on things. So it's all about, for me, when I'm looking at how we're going to work on our climate policy moving forward, it's also about how are we making sure that in everything we do across government, we're taking into account the fact that we need to reduce emissions. We need to create a low carbon economy. And what are the best tools we have to do that? I think the auto strategy that we released about a month ago now is a really great example of that, because you have something that's working on building a strong industrial sector. I'm MP from Ontario. It's a really important part of our economic sector in Ontario. So if you have an automobile strategy that's working on creating those jobs, building more of a manufacturing sector, but at the heart of it, it's also an EV strategy. Like at the heart of it, it's about how do we have the investment tax credits, super deductions to entice that type of investment into building EVs. It has rebates so that Canadians will buy more of those EVs. It has supports for charging infrastructure, again, so that we can use EVs more easily right across our country. Like, to me, that is a policy that's going to work in the long run, and it's going to be something that we can see as to how it translates economically, but also in reducing emissions.
That was part of my conversation with Julie Debrusin, Minister of the Environment and Climate Change, on this week's episode of the Wonk Podcast. Time for the takeaway and what to do when everyone loses their heads. Artificial intelligence is a game-changing technology, already disrupting some jobs. It has the potential in the short term to allow businesses to drastically reduce their costs. In the medium term, some humans will find their efficiency and productivity soar with the use of new tools developed with AI. But long term, the same set of technologies could actually disrupt many businesses altogether. It's that great potential followed by that massive uncertainty that has public stock markets rattled. Many AI-related shares have soared in value in the past year or two as investors overshot the mark, as they tend to do. That means that many of those stocks are due for a pullback of some kind, even if the most positive forecasts remain true. And then there are the stocks of businesses that are stable and long-standing, but that will one day be shown to be undermined by some form of this technology. So what's an anxious investor to do in the face of so much potential volatility? Not being in the stock market isn't a great option. It's been one of the most dependable ways of growing capital. But as the big market corrections of years gone by show us, it can also be a place where wealth is lost, and in a hurry. The most obvious answer to the problem of how to stay in the market in the safest way is also one of the simplest. Diversify your holdings in stocks. That should mean owning as broad a basket as possible of shares in multiple sectors and geographies. It could also mean owning other assets. Owning a home is still a pretty good hedge against lost wealth, and you get to live in it if you can afford to get one. If you're of a certain age, it could be time to make sure you're balancing risk and growth. That could mean giving up a few points of return in favor of dependability. The mix will differ for everyone, and there's never one size that fits all. My takeaway? Markets are a reflection of the future. Ours is highly unpredictable, which makes now the right time to get a handle on your own plans. That's Taking Stock for this week. I'm Amanda Lang. Thanks for being with us.